Okay, good afternoon and welcome to Sensible Financial Planning's webinar, The 5 Biggest Medicare Mistakes. I'm Carrie Fristo and I will be your moderator today. Today, Rick Fine will talk about Medicare and avoiding the mistakes that can cost you money and worry. Rick Fine is the principal and director of financial planning at Sensible Financial. He has an MBA and is also a certified financial planner. You can see all of our past webinars on Sensible Financial's website at sensiblefinancial.com/webinars. And you can register for upcoming webinars on the same link, sensiblefinancial.com/webinars. Please submit your questions through the Q&A link that's at the bottom of your window. Rick will answer as many questions as he has time for. Unfortunately, he can't give personal advice in this meeting. There isn't the time to gather the proper context necessary to do so. But we will display Rick's contact information at the conclusion of the webinar. Going to read a disclaimer. All content is provided for information purposes only. Opinions expressed herein are solely those of Sensible Financial and Management, LLC, unless otherwise specifically cited. Material presented is believed to be from reliable sources, but no representations are made by our firm as to other parties' informational accuracy or completeness. The information provided is not investment advice, merely a recommendation regarding the purchase or not a recommendation regarding the purchase and sale of a security, the implementation of a strategy or a set of strategies, or financial planning advice. There's no guarantee that any statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. There is no assurance that any investment plan or strategy will be successful. Now, Rick will begin today's presentation.
Thank you, Carrie. Hello, everyone. Thanks for joining me today to talk about some common mistakes people make with Medicare. This is a follow-on presentation from my more introductory Medicare webinar that I gave several weeks ago. After today's webinar, you may want to watch that video to round out your understanding of Medicare. It is available on our website, www.sensiblefinancial.com, under the resources menu option at the top of the homepage. Today's talk was originally prepared for people who are not currently on Medicare, but who are planning to enroll soon. However, if you are currently enrolled, the material in this presentation will serve to round out your knowledge of Medicare. In fact, some of the mistakes people make are while they are already enrolled. So you will benefit from having attended as well. I will start today's presentation by giving a very brief overview of Medicare before diving into some common Medicare mistakes. I will take questions toward the end of the webinar. So as Carrie said, please put your questions in the Q&A section, and I will do my best to answer them at the end. So first of all, what is Medicare? Medicare is the federal government's health insurance system for U.S. citizens or permanent residents 65 or older, or younger if disabled. And a qualifying disability is a disability it would have to qualify under the Social Security Administration's definition of a qualifying disability. A qualifying disability, according to the SSA, is one in which your condition must significantly limit your ability to do basic work-related activities, such as lifting, standing, walking, sitting, or remembering for at least 12 months. Medicare has several parts. Some parts are free, others have premiums, deductibles, and/or copays. It's available anywhere in the US, regardless of income or health conditions. Once you enroll, you can never age out of Medicare. And nothing about Medicare is true for everyone. And what I mean by that is that Medicare has a lot of rules, but it also has a lot of exceptions, and not all the rules apply to everybody. When you first enroll in Medicare, you have two options, two routes that you can go to enroll. One is called Original Medicare, and the other one is called Medicare Advantage. Original Medicare is a fee-for-service model. A fee-for-service model is a method in which doctors and other healthcare providers are paid for each service performed. Examples of services include doctor's visits, tests, blood tests, x-rays, etc. Medicare Advantage is a managed care model. A managed care model is a system of healthcare in which patients agree to visit only certain doctors and hospitals within a network, and in which the cost of treatment is monitored by a management company. So original Medicare really refers to Parts A and Part B. So Part A is hospital coverage. So if you go into the hospital, if you're admitted as an inpatient, the costs there would be covered by Part A. Not all of the costs, you have some copays and a deductible. And if you visit a doctor or you get diagnostic tests, that would be covered under Part B, 80%, as you see here. And I'll go into that a little bit more later. But because A and B don't cover everything, if you are on original Medicare, you want to also have a supplement plan, also called Medigap. That will pay the Part A deductibles and copays, and then it'll pay the Part B copays, the 20%. You also want to have a separate prescription drug plan, and that's under Medicare Part D. And then with original Medicare, routine hearing, vision, and dental are not covered by original Medicare. Some people prefer Medicare Advantage because Medicare Advantage is administered under one private insurance company. So you can think of Blue Cross Blue Shield, Tufts Health Plan, United Healthcare, Kaiser Permanente if you live on the West Coast. And you still have to enroll in A and B, but now they're administered through the private company. And Part C, which is Medicare Advantage, Part C and Medicare Advantage are synonymous. Part C covers, also includes the supplement, and it includes a built-in prescription drug plan. So you don't need to carry a separate Medigap plan and a separate Part D plan if you are with Medicare, with Medicare Advantage. And also Medicare Advantage, a lot of the plans cover hearing, dental, and vision, routine hearing, dental, and vision. Obviously, if you have a problem with hearing, with your ear or your eye, Medicare Part B will cover that. So let's take a look at some of the common mistakes people make. Mistake number one is thinking Medicare is inexpensive, or some people actually think it's free. Well, it's anything but free. But it can be quite expensive. Medicare does not cover 100% of your healthcare costs. Parts A, Part B, Part C, D, and supplement or Medigap all have costs associated with them. Some have monthly premiums and deductibles. Most have copays or coinsurance. Some Medicare plans exclude some healthcare costs. So for example, with original Medicare, again, routine vision, hearing, and dental are not covered. So let's take a closer look at what the costs are. What I've done here, and by the way, we're going to send you this table so you don't have to try to memorize. There's a lot of information, cost information on here. You don't have to write it down. We're going to send this to you after the webinar. I've divided it into two tables, one on the left, one on the right. The left table is the government plans. So again, that's Part A and Part B. And then on the right, I've included the private plans. So that would be Medicare Advantage, if that's the route you want to take. Or alternatively, if you want to go the original Medicare route, a separate Medigap plan and a Part D plan, prescription drugs. On the left side of each table, I put the monthly premiums, the deductible, copay and coinsurance, and something called IRMA, which stands for Income-Related Monthly Adjustment Amount. This is a surcharge on top of the premiums for Part B and D. For those higher income folks, IRMA is calculated using your modified adjusted gross income from 2 years back. It isn't difficult to fall into the IRMA trap because modified adjusted gross income includes not only earnings, assuming you're still earning when you take Medicare, but also withdrawals from tax-deferred accounts, which count as recognized income, taxable income, IRAs, pension and annuity income, and investment income. It adds up quickly. So many Medicare beneficiaries will find themselves paying not only the base premium, but surcharges on top of that. So let's take a look at Part A first, the hospital coverage. And again, no matter which route you take, you have to sign up for A and B. For most people, there are no premiums. If you have 10 years of work experience, you don't have to worry. There are no premiums for A. But there are deductibles, and the deductibles, unlike other deductibles, the deductibles are per hospital stay. So you could have multiple hospital stays in a year as long as they're 60 days apart, where you check out and then you wait 60 days, you check back in, the deductible starts again. So you may have to pay more than one deductible if you have more than one hospital stay in the year. And those deductibles are not inexpensive. They're $1,632. And this is in these are all 2024 rates that I'm quoting you here. They do go up with inflation. In terms of copays, if you're in the hospital, the first 60 days, there are no copays. But after the 60th day, from 61 to day 90, copays are $408 per day. And then after the 90th day, if you're unlucky enough to be in the hospital that long, you'll be paying a copay of $816 a day. So that can be really expensive with a long hospital stay. There are no IRMA surcharges for Part A. Part B, the doctor coverage, the base premium is $175 a month. These are monthly premiums, right? The deductible is $240 per year. And then Part B, remember I said Part B pays 80% of Medicare eligible costs, expenses. So you're on the hook for 20%, which can really add up if you have really expensive healthcare. And then with Part B, there is the possibility of IRMA if your modified gross income falls into some of those IRMA thresholds. And there are about 5 IRMA thresholds. And the more thresholds you cross, the higher your IRMA surcharges are going to be. So it varies by your income. If you go the Medicare Advantage route, you're still paying the premium and possibly the surcharge for IRMA. But usually there are no monthly premiums for Part C. Some of them do have premiums, but a big lure for Medicare beneficiaries who are deciding whether to go on Medicare Advantage is that often the plans have no premiums. And also some plans have no deductibles. It just varies. There are copays. They're not to exceed $88.50 per year, and that's actually 2024 quote. And then you might owe IRMA surcharge if your Part C plan includes a prescription drug coverage and you fall into the IRMA income categories, then you might have an IRMA surcharge on that. If you decide to go the original Medicare route and pick up a separate Medigap plan and a separate Part D plan, for a Medigap, the monthly premiums range from $50 to $200, depending on the plan you choose. The deductibles, there usually are no deductibles for Medigap unless you have a high deductible Medigap plan. Most people do not have high deductibles. That's probably more for the younger set, and obviously the younger set is not eligible for Medicare. And then in terms of copays, coinsurance, so Medigap will pay, there are no copays for Medigap. In fact, Medigap will pay the copays for Part A, and it'll pay the deductibles for Part A, which is really nice. And then it'll pay the 20% that Medicare B does not cover. However, it's not free. You have to pay for a Medigap plan, as I said, with the monthly premiums here. Part D, the prescription drug plan, the monthly premiums range from $0 to $200. The national average is about $56 a month for premiums, although you can actually get a plan for as low as 50 cents. Some plans actually cost 50 cents a month for Part D, believe it or not. Part D, the deductibles vary. The maximum you can be charged is $545 per year. The copays and coinsurance for Part D are very complicated, and I have a separate section on this today I'll go over. But it involves 4 phases and 4 drug tiers. There's something called the donut hole. I don't know why they call it the donut hole, but they do. And it's very complicated. So I'll go over that in a few minutes. And just like with Part B, where you have IRMA surcharges, you might owe IRMA surcharges with Part D as well. So let's take a look at a cost example. Actually, I'm going to show you two cost examples. The same married couple named Samantha and Carl. And in this example, Samantha and Carl are both working. Samantha's an accountant, Carl's in sales. They file their taxes jointly. They're age 65 and 67 respectively. They're not self-employed. They work for companies. They're W-2 employees. Their companies have less than 20 people, fewer than 20 people, employees, which is significant for Medicare because the rule in Medicare is that if you work for an employer that has fewer than 20 employees, when you turn 65, if you are on the company health plan, you actually have to get off the company health plan and go on Medicare. So because their employers employ less than or fewer than 20 people, when Samantha was turned 65, which is this year, she has to go on Medicare, and Carl is already on Medicare. They earn pretty high. Samantha's earnings are $275,000. Carl's is $350,000. Samantha takes 2 medications, and probably because Carl's salary is higher, he's got a lot more stress in his job, and he's taken 4 medications. So let's take a look at what the monthly expenses are for their healthcare. So Part B premiums, Samantha they're both paying the base premium for Part B. It's $175. Now they each have different Medigap plans. They're not on the same Medigap plan, and so Samantha's is $125 a month. Carl's is $140 a month. They have different prescription drug plans. Samantha's paying $15 a month. Carl's paying $20 a month. Because their earnings are so high, they actually cross several of the IRMA thresholds. Remember, I said there were 5 of them. They're probably crossing about 4 of the 5. And so based on their modified adjusted gross income, their surcharges are very high. They're almost they're $559 a month for each of them. And then for Part D, it's not as high. It's $74.20 for each of them. So those are the monthly costs. Let's take a look at how that looks on an annual basis. And so in 2024, Samantha is paying for Part A. Again, her premiums are free because she has 10 years of work experience. There is no such thing as IRMA surcharges for Part A. Because she has a Medigap plan, the Medigap plan is covering the deductibles and all the copays. Part B, that 175 base premium comes out to $2,100 a month for annually. And then the surcharge of $559 a month is $67.08 for the year. There's a $240 deductible, as I mentioned, for Part B. And then Medigap will cover the 20% that Part B doesn't cover. But she has to pay for the Medigap plan. And that Medigap plan for her is $125 a month or $1,500 a year. And then Part D has some premiums, again, IRMA surcharge, deductibles, copays. So when you add up all of the various parts of Medicare, you come up with about $12,000 for the year. That's what Samantha is paying for her health care. Carl is pretty much the same thing. I mean, if you look at the pattern here, it's pretty much the same. His costs are a little bit higher because he's on a higher Medigap plan, higher prescription drug plan, higher cost. So the subtotals are going to be a little higher. And so his annual total is about $13,000 a year. So between Samantha and Carl, they're paying about almost $25,000 a year for their health care. And a lot of that is because of the IRMA surcharges. So let's fast forward 1 year. So Samantha is now 66, Carl is 68, and they decided to retire. So they have no more earnings. And same number of medications, they're still paying for Part B premiums, still have the Medigap plan, Part D prescription drug plan, but because they have no earnings, they do have some income. I mean, they have portfolio income, but they don't have annuity income, and they haven't actually started Social Security yet, so they don't have that. So they don't really have much in the way of modified adjusted gross income. Therefore, they don't reach that first IRMA threshold, and therefore they don't owe IRMA surcharges on top of the base premiums. So now look at the annual costs. The pattern is the same, but notice that there is no IRMA surcharge here for Samantha or for Carl. And so the annual total for Samantha is only 4380. The annual total for Carl is only 5260. I say only because it's still between the two of them, it's $10,000 a year. So that's not inexpensive, and they really need to plan for that. But it's nowhere close to what it was a year ago when they were both working and had to pay $25,000 in healthcare. When Sensible Financial develops financial plans for clients, we incorporate realistic Medicare expenses starting at retirement and continuing through life. We take into account all relevant costs associated with Medicare, including any IRMA surcharges we determine the client will incur each year. Moving on to mistake number 2, and this is a really common one. Enrolling late in Medicare. If you're already on Medicare, you don't have to worry about this one. But if you enroll late in Medicare, when you first enroll in Medicare, you will incur penalties in the form of higher premiums that can last a lifetime. The premiums, especially for Part B, are draconian. The later you enroll, the heavier the penalties. Late penalties apply mostly to Parts B and D. If you only pay premium, if you also pay premiums for Part A, which most people don't, because they usually have the 10 years required work experience. But if you did pay premiums for Part A and you were late, you're going to pay late penalties for Part A as well. Medicare Supplement or Medigap does not have penalties for late enrollment. There are different enrollment periods depending on your situation. So it's important that you understand that you know which period applies to you so that you don't enroll late. So let's take a look at those enrollment periods. First of all, there's the initial enrollment period, or IEP. The IEP pertains to those turning 65 and in one of the following categories. Either they have no health insurance up until 65 and then they go on Medicare, or they're enrolled in the Affordable Care Act, Obamacare, the marketplace, whatever you want to call it. And then when they turn 65, they have to go off of Obamacare and they have to take up Medicare. Or they're leaving their employer plan if the employer has fewer than 20 employees, as I said before, they're going to have to leave the employer plan and go on Medicare. So if you qualify for the IEP, you fall into one of these categories. The IEP is 7 months long, and it includes 3 months before the month you turn 65, the month you turn 65, and then 3 months after the month you turn 65. Just 7 months. That's all you have. If you enroll outside of this time period, you are late. You will pay late penalties on your monthly Part B and Part D premiums for the rest of your life. And if you have Medicare Advantage and it has a prescription drug plan, you're going to pay late fees on that as well. If you can remain in an employer plan, either yours or your spouse's, if you're on your spouse's plan, you can postpone signing up for Medicare without incurring late fees. And then when you leave the health plan, and say you retire or your spouse retires, and you have to go on Medicare, then you can pick up Medicare and you get the, you wouldn't be considered late. You can enroll in, while you're on your employer's plan, if you're allowed to stay on your employer's plan, you can enroll in Part A anyway, which is the hospital coverage, when you turn 65. It's free for most people, so there's no reason why you wouldn't want to sign up for that. It would act as secondary hospital coverage to your employer plan. Just be careful that if you enroll in Part A, you don't want to enroll in Part A if you are on a high deductible health plan and you contribute to a health savings account, an HSA, because HSAs do not play well with any part of Medicare. So if you're going to continue contributing to an HSA, maybe you should not enroll in Part A yet. There's also something called the special enrollment period. And this, unlike the IEP, which is based on when you turn 65, age-based, the SEP is based on life events. So when does someone 65 or older qualify for the SEP? If you're retiring and leaving your employer plan, if you're on your spouse's employer plan and the spouse is retiring, or if you've been working overseas, this is probably uncommon, but if you've been working overseas with private or national health insurance and are retiring and then returning to the US, then you'd fit into the special enrollment period. Under the special enrollment period, you can enroll in Medicare up to 8 months after you leave your current employer plan. The SEP is also available to same-sex marriages, opposite-sex domestic partnerships in states that recognize them, and people under 65 with disability. Anything beyond the 8 months, and you're late, and you will incur late penalties that are added to your monthly Part B and Part D premiums for the rest of your life. If you qualified for one of those, the IEP or the SEP, and you didn't make those, you were late, then you can still enroll during what's called the general enrollment period. And the general enrollment period is between January and March 31st each year. The coverage doesn't begin until July 1st. So you're going to be uninsured until July 1st. And you're going to incur late penalties on your Part B and Part D premiums for the rest of your life. Let's take a look at a late penalty example. I'll introduce you to Maxine. And on the right is her story. Maxine, she's now 68 years old. She divorced her philandering husband at age 65 and disenrolled from his employer plan when the divorce was finalized. She liked the health plan. She didn't like her husband, but she liked the health plan. So she went on COBRA for the allowable 36 months. So COBRA, if you're getting a divorce and the divorce is finalized, COBRA allows you to stay on your ex-spouse's plan for up to 36 months. So she decided to keep the health plan for 36 months, thinking that she could just pick up Medicare after that. What she didn't realize is that Medicare doesn't recognize COBRA creditable health coverage. So the late penalties actually started after she passed her 8-month special enrollment period. So Maxine is late by about 2 years. And because of that, she must pay about $436 in yearly late fees. And you can see her, just like I showed you that the box in a couple of slides back, she's got A, B, Medigap, and D. And if she had enrolled on time within that 8-month period, her total healthcare costs for the year would have been $5,390. But because she now has to pay penalties, she pays $420 a year in Part B penalties, and then $16 a year in Part D penalties. That's $436 a year total, just in the penalties, above the base premium. And by the way, she also might pay, she could potentially pay IRMA if her income was that high. But I didn't include that here. But $436 in yearly late fees. So if we plan out to age 100 or 95 or 100, whatever, her lifetime Medicare late penalties will be at least $14,000, which is 436 times 32 years. And probably a lot more than that because we didn't account for inflation, because when the base premium goes up with inflation, the late fees are about 10% of the base premium. So the dollar amount is going to be even higher. So the takeaway on this is don't be late to enroll in Medicare, and know which enrollment period applies to you. And the other takeaway is that Medicare does not recognize COBRA as creditable coverage. COBRA is not bad. It serves its purpose, but after that 8 months, you don't want to be on COBRA anymore. Mistake number 3, not signing up for a prescription drug plan. Why pay for a prescription drug plan if you don't take prescription drugs? People say, well, if you don't take prescription drugs, you're lucky. But the answer is because you might need to take them in the future, and they might be pricey. If you wait to sign up until you need coverage, you have to wait until the next open enrollment period and pay late penalties for life. All prescription drug plans have a catastrophic coverage provision, an out-of-pocket threshold above which you have no copays or coinsurance. So it is really a good idea to sign up for a prescription drug plan, whether you're on original Medicare or Medicare Advantage. Even an inexpensive drug plan, because it has that catastrophic feature, can really save you a lot of money. And I threw in a bonus mistake, which is also very common, which is enrolling in the same prescription drug plan as your spouse, just because your spouse enrolled in that plan. Do not do that unless the plan adequately addresses your own health needs too. Remember, Medicare is an individual program, right? So you want the plan that addresses your health needs, your medication needs, et cetera. Let's take a look at how prescription drug plans work. So first of all, there's this concept of phases. And phase one is called the deductible phase. And that's all it is. You pay the deductible and then you're out of phase one and you're on to phase two. The deductible varies by the plan, but they can't charge you more than $545 per year. Once the deductible is met, you move on to phase two. Phase two is called the initial coverage phase. Now, this phase is the cost to you for the prescription drugs you take will depend on the tier that your drug falls into, and every drug falls into a given tier, or it's just not covered by the plan. So you need to make sure your drugs are covered by the plan. And the phase will end when you, the plan, and the manufacturer paid a combined $5,030 for the year. And I say you, the plan, and the manufacturer because you have a copay, but the plan is picking up some, and the manufacturer of the drug is picking up some as well, or might pick up some. So you're not shelling out necessarily the entire 5,000. It's a combination of the three. But once the combination reaches 5,030 for the year, then you move on to phase three. Phase three is called the coverage gap and also called the donut hole, and nobody's really adequately explained why it's called the donut hole. If it gets it's a hole you fall into, right? The hole used to be much bigger, but thanks to Obamacare or Barack Obama, they negotiated that the coverage gap or the donut hole would close over several years, and it has been doing that. But in the coverage gap, you pay a flat 25% of all your drug costs. And then once you pay a total of $8,000, presumably that includes the 5030, once you pay $8,000 for the year, then you move on to phase four, which is the catastrophic coverage. And that is where you have no more copays. That's why I said that even if you don't take prescription drugs now, it's a good idea when you get on Medicare to get onto a prescription drug plan, because you never know, any prescription drugs you take in the future may be very expensive. They may fall into a high drug tier. And so you want that catastrophic backstop for you. When you get to January 1st of the next year, then you go all the way back to phase one and you start the process again. Now, I talked about drug tiers. I'm going to explain those tiers really briefly to you. That only applies to phase two. Okay, so here are the drug tiers. Tier one is called the preferred generics. So these are the least expensive drugs. Sometimes they're actually free, but if they're not free, they're usually like $5 or $10 for the medication. Often generic drugs. And then tier two is the higher priced generics, and sometimes lower priced brand name drugs fall into tier two. And then tier three is the preferred brands, mainly higher priced brand drugs. And then tier four is the non-preferred or the highest cost prescription drugs, often specialty drugs. They're not necessarily not preferred because they're bad drugs. They're just not preferred because they're high in costs. Some drug plans will have more tiers, some will have fewer tiers. It just depends on the plan. So let's take a look at an example of somebody who named Stefan, who never needs medication. He's now 68 years old. He's never even took anything, even an aspirin in his life. But all of a sudden, so when he got onto Medicare at 65, he decided he didn't want a prescription drug plan. He wanted to save the money. Well, unfortunately, in January, he was diagnosed with hepatitis C. And as you know, hepatitis C is very dangerous. It can do permanent liver damage. So his doctor suggested a drug called Harvoni, which happens to be $95,000 for the course of medication. It's several pills you take over a 3 or 4 month period. And it supposedly knocks out hepatitis C. So he's going to go on Harvoni. If he had enrolled in a prescription drug plan that covered Harvoni, his medication costs would be less than $8,000. Unfortunately, he's trying to get on now a Part D plan, but he's going to have to wait until October, which is the next open enrollment for getting on a prescription drug plan. And the coverage won't even start until the following January. And he can't wait that long. He has to start the drug right away. So unfortunately, he's on the hook for most of the $95,000. And not only that, but because he didn't enroll in Part D at 65, he's now 3 years late, which means he's going to have about 30% more in premiums. Because remember, it's 10% per year that you're late. So 30% more added to his base premium for the rest of his life. And for this example, I used a medical condition that has a relatively short-term fix. There are many other illnesses that are not curable and require taking specialty drugs, very expensive drugs over the long term. This can be financially devastating if you don't have a prescription drug plan, and therefore you don't have that catastrophic phase 4 backstop for you. So for most people, it would be wise to enroll in a prescription drug plan when you first enroll in Medicare, because you never know if you will need expensive medications at some point in your life. Mistake number 4, failing to review your private coverage. Remember, private coverage would be either the Medicare Advantage coverage, or if you go the original Medicare route, it's the Medigap and the separate Part D prescription drug plan. Those are private, bought through private companies. They're not administered through the government. That's why I call them private plans. So failing to review your private coverage. Now, with Medigap plans, there's really not much to review other than the rates, because the benefits don't really change. Most of the Medigap plans, they pay the 20% of what Part B doesn't cover, right? So the benefits don't really change. It's really the rates. You want to make sure that when the rates go up, they don't go up astronomically. And if they do, you may want to look for another Medigap plan. And then Part D. Oh, and I should mention when I first started this, Medicare beneficiaries receive something called an annual notice of change, abbreviated as ANOC or ANOC, every September, usually in the mail. This document informs them of changes in their private Medicare plans. So if you're on Medigap, it'll tell you what the rate is for the next year. If you have a Part D prescription drug plan, the thing with Part D is that they can change pretty much everything. They can change the premiums, they can change the deductibles, the copays, coinsurance. They can change the drug formularies every year, and they often do. They usually do. So you want to check the formularies. A formulary is a list of the drugs that your Part D or your prescription drug plan covers, and what tiers they fall into, and what the copays are. And those formularies are going to change at least once a year. So you really do want to make sure that the drugs that you're taking, if you are taking drugs, are in a tier where the price has not gone up, too much. And they can also change preferred pharmacies each year. Because if you use their preferred pharmacies, you can often reduce your costs. So if they change the pharmacy to a pharmacy that you don't go to, or you're not likely to go to, then that could be a problem for you. Medicare Advantage plans also can change everything. In fact, they can change their list of doctors that are in the plan, because remember, Medicare Advantage is a managed care plan. You can pretty much only use the doctors that are in that network, which is usually a geographic area, as opposed to original Medicare, where you can use any doctor in the country, as long as they take Medicare, and most do. And so in your area, doctors could just leave the Medicare Advantage plan. Hospitals can leave the plan. Pharmacies can leave the plan. And in fact, they often do. And so you want to make sure that your doctor or your hospital is still covered in the plan that you're on. And if they're not, you really should think seriously about changing your Medicare Advantage plan. And by the way, that has been a big controversy with Medicare Advantage. So has a lot of people in uproars about that. So, and after today's webinar, we're going to send you a list of questions that you should be asking about your private health plan when you receive your ANOC. Also, regarding the failing to review your coverage, you can make changes during your annual election period, AEP, often called Medicare open enrollment. And again, this is for people who are already on Medicare. It's not the IEP or the SEP, but for people who are already on Medicare, your open enrollment period, which runs from October 15th to December 7th every year. The options that you have for making changes to your plans without undergoing medical review or medical underwriting, same thing. You can enroll in, leave, or change your Medicare Part D prescription drug plan. You can switch from original Medicare to Medicare Advantage if you want. And you can switch between two Medicare Advantage plans, all without undergoing medical review. If you want to switch from a Medicare Advantage plan to original Medicare, you might be subject to medical review. It depends on which plan that you're going to with original Medicare. So if you're trying to switch up, like get more benefits, you might have to undergo medical review. It also depends on the state. Now, there are about 13 states in the country. I think Massachusetts, my home state, is one of them, where you don't really have medical review. So you can switch, as long as you're switching during the open enrollment period, you can switch, no questions asked. And also, if you want to switch between two Medicare supplement plans, Medigap plans, you can do that any time of the year. You don't have to do it during the October 15th to December 7th. But again, you might be subject to underwriting after the first 6 months you're enrolled in Medicare. Again, it just depends on which plan you're going to and which state you live in. Okay, mistake number 5. Assuming pre-existing conditions don't matter. So it is true that pre-existing conditions don't matter when you first enroll in Medicare. When you first enroll in Medicare Part B, you have 6 months to enroll in a Medigap plan or to switch Medigap plans with no questions asked, no medical review or anything like that. That initial 6-month period is called a guaranteed issue period. It occurs for most people once. It's not annual. The exceptions to that are where you may be eligible for more than one general guaranteed issue period, are if you are under 65 and enrolled in Medicare due to a disability, you'll be eligible for another guaranteed issue period when you turn 65. If you disenrolled from Medicare because you were first on Medicare and then you got a job with a employer that had 20 or more employees, and you liked their health plan and you wanted to go on their health plan, you can disenroll from Medicare. And then when you eventually retire from that company and you go back on Medicare, you won't be considered late. That's a qualifying enrollment. And you'll be subject to you'll have the guaranteed issue period of 6 months where you can sort of decide what you want to do and which plan you want to be in, no questions asked. Or if your Medigap insurance company goes out of business, not likely to happen, but it does happen on occasion. Now, for those of you who are, in some states, the guaranteed period is permanent. You can change plans any year during the annual enrollment period, October 15th to December 7th, no questions asked. Again, there are about 13 states in the country where that's true. But in those states where the 6-month GI period does apply, you may be required to undergo medical review to change Medigap plans after it expires. You may have to pay higher premiums for a plan with more benefits, or you may be denied coverage in that plan. So you should be prepared to have your medical records reviewed and to be interviewed by phone by the plan that you're wishing to enroll in. Know what is in your medical records. Most people do not. And answer only what is asked of you in the either on a written application or in the interview, the phone interview. And to avoid the possibility of Medicare medical review, your first Medigap plan should really be the best one for you, the best one that you can afford. Don't try to do it on the cheap. Now, if you decide to go on Medicare Advantage rather instead of original Medicare, you may be eligible for additional GI periods. The common scenarios in which you can switch after the GI period has expired include if your Medicare Advantage plan stops covering stops offering coverage in your area, your geographic area, then you're allowed to have another GI period. You can switch plans. If you move out of your plan service area and lose your coverage, you can switch plans. And if you enroll in a Medicare Advantage plan for the first time, you have 12 months to switch to a Medigap plan if you're unhappy with the Medicare Advantage plan. And this is a one-time opportunity. Okay, so those are the 5 Medicare mistakes. Carrie, I think we're ready to take questions.
Okay, we do have quite a few questions. Let's see. Someone asked, do qualified charitable contributions add to IRMA or count toward IRMA? Or do they help you avoid IRMA costs?
To the extent that they affect modified adjusted gross income, then I would say yes.
Yeah. Great. Okay. Mitch is saying that his mother's Medicare plan gives her money toward groceries and even internet service. Is that common?
For Medicare Advantage plan, there's no telling what they're going to add in there. They do it. They even have, I think, some. They give you some money back for gym memberships, and so yeah, Medicare. I haven't heard of the groceries part, but that wouldn't be under original Medicare, I'm pretty sure, but it would be under Medicare Advantage.
Medicare Advantage. Okay. Let's see. Well, someone's just asking a simple question. We're under Medicare right now. Medicare seems to have a lot of paper statements. Do you know if is there any way to get it paperless, to just get it electronically? Because she doesn't want to
Yeah,
waste.
I do not know. That is a very common complaint. What I would say is you could either call Medicare and talk to somebody there, or call Social Security, the Social Security Administration. And we're going to send, I think we're going to send that number for the SSA in the follow-on handout that we're going to send people.
Yes.
So either call, I would say start with Medicare, call Medicare and see if they can do something for you. But it is annoying, I know.
Okay. Janet wonders, are there any disadvantages to enrolling in Part A at age 65 if you're covered by a qualified employer plan by either your employer or your spouse's employer? Are there disadvantages?
The only disadvantage, as I mentioned before, is if you are on, if you have a high deductible health plan with your employer plan, employer health plan, and you are contributing to a health savings account, you really don't want to enroll in Part A while you're still on your employer's plan and still contributing to the HSA, because if you do that, then you'll be penalized and you'll have to back out. You'll have to take money out of the HSA, the health savings account. It's a mess. So you don't want to do that. But other than that, I'm pretty sure there's no downside of doing that. And people do it all the time.
Okay, sure. Okay, if you're getting retirement income and investment income and taking RMDs, and your adjusted gross income is above the IRMA thresholds, is there a way to keep your IRMA, to keep your income lower, to keep your AGI lower?
Yeah, so unfortunately, required minimum distributions are considered taxable income, and that's why the government wants its money. That's why they require that you take RMDs and that you have to report that income and then you have to pay taxes on it. It gets included in your modified adjusted gross income, your MAGI. I would say anything that gets your MAGI down and under the threshold will save you the IRMA premiums or IRMA surcharges. And I'm not a tax accountant, so I can't give advice on that. But go see your accountant if you have one, and see how you can do that.
Mm-hmm. Okay. Okay, how long do Samantha and Carl have to wait after they retire for the high income fee to be adjusted?
Yeah, that's a good question, and I should have mentioned that in that example. Remember, I said that when Samantha and Carl were 66 and 68 years old, they went off. They retired, and they didn't have the IRMA surcharges. So the only way to do that, because remember, IRMA is calculated by looking at 2 years ago, your modified adjusted gross income from 2 years back, right? So theoretically, at Samantha's age 66 and her age 67, they're still looking at her magi when she was working. And they're doing it with, they'd be doing that with Carl as well. But the way to get around that is you can actually petition. It's called a change of life event petition. There's actually a form for that. I don't remember the form number. It's a Social Security, it's an IRS form, I think. Social Security, it's a Social Security form. And you can fill that out and petition and say, you had a change of life event, which is that you retired. That's a qualifying change of life event. And they will, if you petition them successfully, they will look at your current year's magi instead of 2 years back. But then you have to petition 2 years, right? Because you have to get 2 years past in order for them to see your income for what it really is. So you might have to do 2 years of petition, but people do it.
Okay,
So that would
yeah,
be the way to do it. Yep.
okay, okay, Rick, can you speak to the look back period? That is, oh, okay, is that the same thing? Oh,
Yeah, probably. Yeah. Mhm.
that's about the same thing. Yeah, okay. So sorry,
Yeah. So they look back 2 years when they're setting your IRMA
right.
for the current year, just so there's no confusion.
Yeah, okay, this is a comment that someone's making saying that, the Part D, even though you have an initial period of 8 months, the Part D still has a 62-day period from
Yes,
the
that's
end of the,
correct.
so you need to get your Part B enrollment done quicker than 8 months so you can enroll in D on time.
That's correct.
Okay, that was just somebody pointing that out. Thank you very much. Um, okay, can you address the availability of coverage when you're traveling?
For Medicare in general, yeah. So if you're traveling anywhere in the United States, you can see any doctor. If you're on original Medicare, you can see any doctor within the 50 states that accepts Medicare patients, and probably 95% of the doctors do. And so that's original Medicare. If you're in, and also I think if you're traveling internationally and you have an emergency, then if you have a Medigap plan, if you're on original Medicare, and you have a Medigap plan that covers emergency care abroad, then you can use that. It won't handle routine. Like if you live abroad for, out of the country for 6 months, you can't use Medicare for that. Medicare Advantage, again, you have to, for most plans, you have to be in a certain geographic area. You have a network, and that network is in a geographic area. So, I mean, in places like Boston, you have even, if even your network in Medicare Advantage is probably going to be pretty broad because Boston has, very good healthcare and great hospitals, but it's not necessarily that way in the rest of the country.
Mhm. Okay, how well does Medicare play with Amazon Pharmacy, GoodRx, Costco? Do you have any idea?
So the prescription drug plan, the Part D, um, you can actually get mail order. It depends on the plan that you have. The plans do have mail order, and they have. I think they have. Some of them have Express Scripts. Some of them use CVS mail order. So yeah, you can do that on a prescription drug plan.
Okay. Um, can you explain some of the Part D changes that will occur in 2025?
The only one that I'm aware of right now is that the donut hole that phase 3 is going to shrink even further, and so it actually might go away, and so your out-of-pocket costs will be a lot less, like $2,000 or something.
Oh,
That's one of the biggest changes in Part D.
well, that's good news.
Yeah.
Let's
But I will
see.
say, I mean, Part D can change a lot of things, right? So you have to look at your particular plan. I don't think that was the nature of the question. It was sort of, from a policy standpoint. Um, but you do need to reevaluate your prescription drug plan, whether you're on Part D, which is a separate plan, or whether you have a Medicare Advantage plan that has prescription drugs. You really do need to look at the ANOC every September to
Mhm.
see where you stand on that. Because sometimes they'll, if you're taking a medication and they bump it from tier 1 to tier 3, or they just bump it off the formulary altogether, then you're sort of out of luck. You only have that open enrollment period to change. Otherwise, you have to
Okay.
wait a whole year. Okay.
Um, let's see. Okay. Dental insurance. This person is asking, um, whether to go with Medicare Advantage or supplemental, or is it separate? What are the typical costs involved and what's the coverage? I think that's
Yeah.
very dependent on the plan.
So original Medicare doesn't have routine dental. It doesn't have routine hearing, routine vision. Obviously, if you get into a car accident and you smash your teeth in, it's Medicare will cover the medical costs on that. But for things like teeth cleaning, they don't cover that. And you could get separate dental insurance. My experience with dental insurance is that it's um, expensive and doesn't cover a lot. So you want to sort of think about the benefits and the costs. If you have Medicare Advantage, it will cover some. If it You have to check the plan. Every Medicare Advantage plan is different, but there are plans that will cover routine dental. I don't know what the costs are on that. So
Okay. This person said she began drawing, she receives Social Security and TRICARE benefits. Um, will Social Security automatically enroll me in Part B? And she said she understands that to maintain TRICARE benefits, she has to enroll in Parts A and B.
yeah, I am not that familiar with
Yeah,
TRICARE benefits.
yeah.
Sorry.
Yeah, I'm not either. I know that, yeah, I don't think the Social Security automatically enrolls anyone in anything, but I don't know. That's just me.
Well,
I
they
would
do.
definitely ask about it.
Social Security will enroll you automatically in Medicare under certain circumstances.
Uh-huh,
But I can't speak to TRICARE. I just don't.
right.
That's one
I mean,
area
maybe
I'm not
you can
familiar with.
maybe check with the VA about that, if that's where you're getting TRICARE from. Um, and then,
And actually, Kerry, I may be able to answer that. You might want to just log that as a question that I could look into. I'll see if I can do a little research on that.
sure, because I was gonna suggest that the person call too, because they, just to call the
Mhm.
Social Security office or or check with the VA too. Um, okay, so a couple people asked this question. In the example you gave about Stefan and the drug that he needs to go on to cover his illness. What if he's enrolled and the drug isn't in his formulary because he didn't realize he had it? I mean, obviously you don't know you're gonna get sick with a
Right,
certain disease.
right. I mean, uh, yeah, that's a problem.
Yeah.
Um, he could file an exception. There's no guarantee, but he could file an exception with the plan. People do that sometimes. But if he's close to open enrollment, he can also switch plans. That would be one way to do it. You find a drug plan that would cover Harvoni.
Okay. I know we're getting close to the end, but I just wanted to cover this one question because I thought it was a good question. If you continue working past 65 for a large employer who continues to cover you, you continue to get health coverage from, will you pay the late penalty if you don't do Part D, buy a Part D plan by 65?
As long as your employer has, as long as your employer plan has a prescription drug coverage that is creditable. That's it. They say creditable. It just means it's at least as good as what you would get through Medicare, right? If it's creditable coverage, then you will not be penalized with late penalties when you eventually do go on Medicare and go on a prescription drug plan.
Okay. And then, oh my gosh, there are a lot of questions. And I just don't think we have time to get to them all. But I can say that what we can do is we can take all these questions down and perhaps we can get in touch with the people who asked them. Some of them are anonymous, so we can't really do that, but perhaps we can address them in something that we send out to all the registrants. Also, Rick's email address, contact information is going to be
I
at
didn't
the
talk
end
about
of
the
the
key
web.
takeaways yet.
Okay.
So why don't I do that, and then we'll let people go. So here are the key takeaways from this presentation. Your financial plan should incorporate realistic Medicare costs throughout life. Understand the various enrollment periods so you don't enroll late. Understand the costs of private plans so you choose the right one for you. Review your private plans annually for changes that might be costly. Choose the best plan you can afford. You might not be able to upgrade later, and don't be late. Okay. Thank you for attending today. I hope this information I provided gave you a deeper insight into Medicare and identified some common pitfalls. If you do have questions and you want to reach me directly, my email address is shown on the left here. And again, if you missed my introductory webinar presentation titled The A, B, C, and Ds of Medicare, you can find it on our website, sensiblefinancial.com.
Sorry, go ahead, Rick.
And we have also an upcoming webinar on March 27th called The Essential Estate Planning Document You've Never Heard of, presented by Frank Napolitano, who is a senior advisor at Sensible Financial. So you may not want to miss that. Okay. Well, thank you again.